Good afternoon, everyone, and welcome to today's headline roundup. It is July 18 already. How about that? Dennis, you ready to roll?
Let's go, Mark. Hey, welcome everybody. I have a lot to talk about as I go through the material today. If you have a question, please type it in the questions box on the right-hand side of the screen. As he usually does, Mark will help me keep an eye out for questions on our relatively new platform here that I am still getting used to. As I mentioned, a lot of topics to talk about today. As previously discussed, consumer spending is now being driven increasingly by debt. That is a pattern that cannot continue. Despite the sanctions against Russia, Russian oil revenues are higher than they were before the sanctions. Manhattan rents reach ridiculous. I'll talk to you about why, although there is a hint here in the next bullet point. The real estate market is slowing. I want to give you the housing bubble in a snapshot. And I want to give you proof the metals market is manipulated. Actually, I talked to Mark about this earlier this morning. Inflation continues at a blistering pace, and in order to get inflation under control, we need to have real positive interest rates, and we're not even close at this point. So again, a lot to talk about. I'll jump in here and let's talk about consumer spending. The U.S. personal savings rate is near a 5-year low. Government stimulus money is drying up. If you look at the chart on the screen, the red line represents the U.S. personal savings rate as a percentage of disposable personal income. So if you take a look at the savings rate really going back to March of 2020, it has declined from over 30% now to around 5%. And the blue line represents consumer credit. And this is largely credit card debt. So you'll notice that as savings has declined, that gap, if you will, that shortfall in savings has been actually funded by credit card debt. And that is something that is, as I said, not sustainable. Consumers continue to spend with credit, but the question is how long can this continue? And my take would be not much longer. Again, from a little different perspective, you see the top of the chart is the savings rate year over year. You see year over year, the savings rate is now negative, and you see year over year that credit card spending is up significantly. So this obviously leads to the risk that there's a lot more downside to stocks. And as I have pointed out in the past here on the Headline Roundup webinar, the U.S. economy is dependent more than 70% on consumer spending. At this pace, consumers, if they're not already tapped out, they soon will be. So that will likely mean that equities have nowhere to go but down as the economy sinks deeper into a recession that I believe we have been in since the first of the year. Now, Russian oil revenues continue to climb. This is an article from July 14, just last Thursday. Russian export revenues in June rose by $700 million to the $20 billion mark, despite the fact that oil exports fell by 250,000 barrels a day month over month. That's simply because oil prices are much higher. Compared to a post-war peak level in April, total Russian exports in June were down 530,000 barrels a day, or 7%, but export revenues were up by 13%, reflecting a higher oil price. Crude oil exports were down by 250,000 barrels per day in June to just above 5 million barrels per day. Crude oil loadings to European Union destinations fell for reasons outlined. So the fall in crude oil volumes came mostly from lower loadings on the Black Sea. Total product exports out of Russia were really relatively unchanged in June. Diesel exports increased a bit. So the sanctions are really not at this point hurting Russia as their oil revenues continue to climb. This is a crazy statistic. You'll see that I titled the slide, Manhattan Rents Reach Ridiculous. Robert Frank wrote a piece reporting that the average rent in Manhattan was a record $5,000 last month. This article was also published last Thursday, the 17th. The average monthly rent for a Manhattan apartment surpassed $5,000 for the first time. That is a very, very high number, and brokers say demand and prices are headed even higher into the fall. Why is that? Well, we'll talk about that in a second, largely because people are renting as opposed to buying. The average apartment rent in June was $5,058, the highest on record. That's according to a report from Miller Samuel and Douglas Elliman. Average rental prices were up 29% over last year, while median rent was up by 25% to $4,050 a month. Keep in mind that the median rent of $4,050 per month means that half of rents are higher than that, half of rents are lower than that. Now, aside from pricing out a lot of renters, the increases could have knock-on effects amid broader inflation pressures. Rents are a key component of the government's Consumer Price Index. The Consumer Price Index, which is the official measure of the inflation rate, increased 9.1%. There's no signs of a slowdown, Jonathan Miller said, who is CEO of Miller Samuel. He said higher mortgage rates and fears of a housing downturn are driving more potential buyers into the rental market. In other words, those who are thinking about investing in real estate are now saying, wait a minute, I think what I'll do is rent for a while, even though the prices are very high, and I want to see how things shake out. That tells you that we're starting to see some doubt in the fact that the real estate market can continue to rally like it has been. Now, at the same time, the supply of Manhattan apartments available for rent is now near record lows. The vacancy rate at the end of June was just 1.9%, down 46% from last year. Brokers say many families and renters who left the city during the pandemic are now returning, despite concerns about high crime, taxes, and troubled subways. Younger renters are also pouring into the rental market. Millennials and even some members of the Generation Z demographic are coming to the city after college or working remotely from high-rise rentals to take advantage of the city's culture and nightlife. So people, especially younger workers, are returning to New York. This is seasonally a very good time for renting apartments in New York. And the article concludes by saying that bidding wars are now routine for rentals. There are people bidding rents up from $5,000 a month to $6,750 a month is just one example given in the article. Now, in another sign, the real estate market is slowing. This is from the Arizonan. Sellers are flooding the market with listings. New data from the Cromford report shows sellers are dumping listings into the Metro Phoenix housing market at a rate 34% higher than average. So while there were low inventories not that long ago, inventories are very, very quickly building. In the most recent four-week review, Cromford found 1,845 listings had been added to the Arizona regional multiple listing. The report said the greater Phoenix housing market is shifting faster than it had seen at any point in the past 22 years. We're seeing the fastest cooling trend that the greater Phoenix housing market has ever experienced. The increase in supply comes as demand is falling rapidly due to the Fed's aggressive increases in interest rates. Both Cromford and Freddie Mac expect higher mortgage rates will increase a sense of balance in the housing market, cooling what had been a blistering rate of increase in demand since the pandemic started to recede. So Metro Phoenix, the article says, has experienced price increases yet. although I expect that will probably reverse as the 30-year fixed mortgage rate has gone just about double from 2.75% to more than 5.25%. Officials with bank rate estimate prices may level out and not decrease for the next 2 to 4 years. I would take exception to that. I think you're going to see lower real estate prices before 2 to 4 years. Once this bubble begins to burst, typically bubbles unwind about as fast as it takes them to build. And this housing market has really built quickly over the past couple of years. Freddie Mac economists have said the national housing market is in the initial stages of the most significant contraction since 2006. That's how it feels to me. Mortgage applications are expected to decline sharply over the summer and have already decreased by more than 40% since their 2021 high. Now, if you want to take a look at the housing bubble in a snapshot, this is a really good chart. If you look at the blue line, it represents U.S. housing prices. The red line represents U.S. wages. Now, the chart goes all the way back on the left-hand side, as you'll see, to 1990. And you see that from really 1990 through 2002, housing prices rose at about the same rate as wages. Then, however, in 2002, 2003, in response to the tech stock bubble unwinding, Alan Greenspan dropped interest rates to very low levels. That created a housing bubble. And notice what happened in 2006, 2007. You saw housing prices increase at a much faster rate than wages, only to see them unwind. Then recently, in response to COVID, we saw government stimulus, we saw significant currency creation, and now you see a bubble compared to wages that's far more extended than it was in 2006. I believe that this chart tells the entire story. I believe that we're going to see lower housing prices ahead. And if you'll notice, back in 2006 or so, if you look at the peak of that bubble, you'll notice how symmetrical that chart is from the time the bubble began until the time the bubble bottomed. And you see it took just about as long for the bubble to build as it did to unwind. And you see the prices ended up about where they started. I think that you see the bubble this time has built much more quickly. So given that bubbles are often symmetrical, I would expect that this one will unwind a lot more quickly as well, particularly now that interest rates have doubled in really the last 6 months or so. So that snapshot, I think, is very telling and gives you a lot of information. Now, I thought this was a very interesting story. And you'll see the title I put on the slide, Proof the Metals Market is Manipulated. I actually asked the question. This article also from last Thursday, July 14, the title of the article is JP Morgan Gold Trader Turned Whistleblower Lied to Authorities. This is from Bloomberg. When FBI agents knocked on the door of his Brooklyn, New York home in August 2018, trader John Edmonds told them he didn't know anything about gold and silver price manipulation at JP Morgan Chase. That was a lie, he admitted Thursday. Edmonds, who worked at JP Morgan for about a decade, eventually pleaded guilty to conspiracy and commodities fraud and agreed to cooperate with prosecutors. He's now a key government witness against his former boss, Michael Nowak, the longtime head of the precious metals trading desk, gold trader Greg Smith, and hedge fund salesman Jeffrey Ruffo. So Nowak, Smith, and Ruffo are now actually being testified against by Mr. Edmonds. Now, during 2 days of testimony at a criminal trial in Chicago, Edmonds described how the three senior executives routinely used spoof trades. The article explains what a spoof trade is. A spoof trade is a huge order that is quickly canceled before it can be executed. The spoof trade has the objective of pushing the precious metals price either up or down. And this occurred, according to Edmonds, from 2008 to 2016. And this is done to make trades for the bank and his clients more profitable. Edmonds said he learned how to spoof while he was employed at JP Morgan. Now, Nowak's defense lawyer, a gentleman by the name of David Meister, cross-examined Edmonds and, of course, attacked his credibility. Edmonds testified that he'd committed no crime since leaving JP Morgan in 2017. However, Meister pointed out that during his FBI interview in 2018, he did lie. Now he has said that he owned up to what he did. It's what happened, and the penalties are the penalties, and Edmonds is now cooperating, as I mentioned, with prosecutors. So this shows that the metals market is a bit manipulated, and it talks a bit about how spoofing works. And this has not been anything that has been alleged. This is the same company that actually paid $1 billion in civil and criminal penalties for rigging the metals market. So for those of you concerned about where the metals prices have been and where they're going in the recent pullback, I believe that metals are still a good long-term hold fundamentally, and I believe the fundamentals will overtake this market at some future point. The annual profit of JP Morgan's precious metals desk varied, but it never dipped below $100 million in a year. In its best year, it made more than double that. Edmonds was hired at a salary of $80,000 in 2008. By 2017, he was making $300,000 annually, and this trial is still ongoing. Now, inflation is continuing at a blistering pace, and again, let me remind you that if you have a question, you should go ahead and type it in the questions box on the right-hand side of the screen. I see we have really good participation today, so Mark, I'm not seeing any questions, but please just jump in and interrupt me if I happen to be missing a question.
Well,
So
good
this
so far.
article, I'm sorry, Mark.
No, you're good so far. No questions yet.
All right, thank you. So inflation was up 11.3% according to the producer index in June, and that is near the highest ever recorded. So inflation is continuing at a blistering pace, as I put at the top of this slide. Inflation, as measured by producer wholesale prices, ticked up to a red hot 11.3% for the year ending in June. That, again, is near the highest on record. The consumer price index, which is typically used as the most common measure of inflation, jumped to 9.1%. That's the highest level since 1981, so the highest level in 41 years, and a bigger increase than anybody was expecting. Now, the new producer price index numbers are just another indicator that prices are wildly out of control, even as the Fed moves ever more aggressively to jack up interest rates to rein in the country's historic inflation. Now, regardless of what these articles say, I would argue that the Fed is not moving aggressively. And I'll talk about this more as today's broadcast continues. The producer price index, the index this article is reporting on, measures the wholesale prices of goods. Now, obviously, wholesale pricing eventually gets passed on to retail consumers. Economists with Oxford Economics said despite a modest improvement in supply conditions, price pressures will remain uncomfortable in the near term and bolster the Fed's resolve to prevent inflation from becoming entrenched in the economy. I think it's a little late for that. Inflation is entrenched in the economy, and the Fed is not taking nearly bold enough action to get inflation under control, in my view. Stating the obvious, the article said the high rate of inflation has politically damaged President Joe Biden and undercuts support for spending proposals from the White House and congressional Democrats. Last month, the central bank hiked its interest rate target by a whopping 3/4 of a percentage point. I would argue that's not whopping, although that's the first time that there has been an interest rate increase of that magnitude going all the way back to 1994. Most typically, the Fed jumps interest rates by 1/4 of a percentage point or 25 basis points. 25 basis points equals 1/4 of a percent. 100 basis points equals 1%. So despite the fact that the Fed increased interest rates triple what the historical interest rate increase had been, it's still a pretty low interest rate. Now, the Fed's going to meet again later this month. It's likely going to raise rates by another 0.75% or 75 basis points. Many analysts are saying, no, the Fed's going to raise interest rates by a full percentage point. Atlanta Fed President Raphael Bostic said that everything is in play, including a full percentage point hike. There are concerns that the Fed's aggressive cycle of rate hiking will knock the economy into a recession. I say that's a valid concern. I believe that inflation will continue with these modest interest rate hikes, and I believe that we are already in recession. The National Bureau of Economic Research defines recession as a significant decline in economic activity that is spread across the economy that lasts more than a few months. 2 straight quarters of downward growth are typically viewed as recessionary. That's how I would define a recession. And again, I believe that we're there. This article pointed out the economy contracted at a 1.6% annual rate in the first quarter. And last week, the Atlanta Fed reported that GDP will decrease for a second straight quarter. In fact, the last estimate I saw was a 0% growth rate, but those growth numbers are typically revised a couple times. Now, do we have real positive interest rates, which is really what we need to have in order to get inflation under control? This is an excerpt from a chart that I pulled from tradingeconomics.com. It's a chart of the Federal Reserve's federal funds rate. The excerpt says Fed policymakers continued to anticipate that ongoing increases in the Fed funds rate would be appropriate and backed a 50 or 75 basis point hike in July. Again, a 50 basis point hike is 0.5%. A 75 basis point hike is 0.75%. Officials also noted the U.S. economic outlook warranted moving to a restrictive stance of policy, and they recognized the possibility that an even more restrictive stance could be appropriate if elevated inflation pressures were to persist. And I believe that you're now seeing that they are persisting. When you take a look, though, at the Fed funds rate, you see the Fed funds rate is still under 2%. So with inflation at 9 to 11%, believing the official numbers, and much higher than that when you look at some private analysts, we're a long way from real positive interest rates. I have stated many times here on the Headline Roundup broadcast that until we get real positive interest rates, it's going to be very, very difficult to get inflation completely under control. So I have gotten out of there. There's my last slide for today. We do have about 4 minutes left. If anybody has any questions, I'll hang out here for a minute. A lot going on in the economies and in the investing markets. If you are not using revenue sourcing to manage your assets, most of you on this call today are using revenue sourcing. If you're not, I would encourage you to check it out. If you'd like more information, you can give the office a call. Our number here is 866-921-3613. And if you know of somebody that might appreciate an invite to the live Headline Roundup webinar, you can give the office a call and we would be glad to give them an invite as well. The number here again is 866-921-3613. 866-921-3613. So that said, Mark, that's what I need to cover. We do have just a few minutes left here. If anybody has a question, we'd be very happy to take it. If anybody has a comment, be very glad to hear a comment. If we don't have any
questions.
Oh, we do. Okay.
Yeah, we do have some questions related to your gold topic. The first couple come from Jeff. Uh, they are, what does the collapse of the rig trading look like? What will bring the manipulation of metals markets to an end? And then his follow-up question was, my understanding from an interview of an auditor of the big bullion banks is that they are overworked and understaffed, and they do not have authority. They can't handle out penalties. What's going to stop this criminal behavior?
Well, I think, Jeff, good questions, good points. I have not commented, or I've not read any comments, or I've not read any good research on how overworked regulators are. From my experience in working with regulators, and I say this a bit tongue in cheek, when you talk to them, they're all overworked. I think bottom line is this, in my view, we're not going to be able to, these banks are not going to be able to manipulate the basic fundamentals. So what I mean by that is that when you take a look at the COMEX market, which is a highly leveraged market, many futures traders in gold and silver are now standing for delivery. They're taking the metals versus taking the profit or rolling their contracts over. The numbers that I've seen are that the number of contracts on which delivery is now demanded, to use that term, has increased by tenfold in the last couple of years. So I think that ultimately, as more people look for an inflation refuge, that you're going to see metals really take off. And I think it's going to be very, very difficult to be able to spoof these markets. When trading volume increases to the point that it's going to be difficult or impossible to spoof, I think that's when you'll see things turn. So you can't change the economic reality of the fact that every currency in the world is a fiat currency. Every fiat currency in the world is being devalued, and history tells us whenever that happens, ultimately, eventually, citizens who are using a fiat currency demand that there's a currency put in place that they trust. I think that's ultimately where we will end up. I can't tell you exactly what that is going to look like, but I'm confident the fundamentals will ultimately prevail. So I hope that answers your question.
And a similar question from Ed. Why has gold not gone up, but has gone down with all this inflation? And let's see, we hear so many other countries are buying more gold.
Well, again, I think that this is a market that is very easily manipulated. I think that it is highly leveraged, and the more leveraged a market is, the easier it is to manipulate. So I think the article does a good job of explaining why we're seeing the price of metals being held down. And again, I do expect that long-term metals are going to be a good place to be. Until we get real positive interest rates, as you see on the screen, we are going to continue to get inflation. We're going to continue to have inflation, and those with assets are going to be looking to move to something a bit more tangible, and many, of course, have already. So again, kind of the same answer that we talked about with Jeff, but again, hopefully that gives you at least my opinion on the topic.
Can you send the link to that article, Dennis, and I will add it when I post the video this afternoon.
Okay, I'll be glad to shoot that over to you so you can go to the Retirement Lifestyle Advocates website and you can click the link on the article and we will see you.
And one last question, again from Jeff. It says, but if the big bullion banks are selling short to push down the price and keep them down, will they be able to afford to have the prices rise because their balance sheets will blow up, and then won't banking system become destabilized? Isn't this why the game continues and nobody's really going to stop it?
Well, yeah, I mean, you raise a good point, but again, I expect that if big banks are short and they're putting in these trades to keep the prices down, I expect there's a very good chance that they will be caught in a short squeeze as prices move up. So a short squeeze would require that these banks cover their short positions, and as they do that, that alone will be a catalyst to drive prices higher. So again, I go back to the fact that the fundamentals have not changed. The currency creation we've seen created a prosperity illusion, and now that rooster's coming home to roost. I think the same thing will happen as far as metals prices are concerned.
Okay, that's all the questions we have, and we're just about out of time.
Well, we are out of time. Appreciate, I did see that, Jeff. Thank you for the nice comment. We will be back again live next week. Next week is the 25th already. So last Monday in July. So you guys have a great week. If you have something you'd like me to cover on a future webinar, please let us know. Again, the office number here is 866-921-3613. So Mark, thanks, and we'll go ahead and end it there.
All right, we'll wrap it up there. We'll see everybody again next Monday at noon. Have a great week. See you then.